presentation contains current opinions of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that those opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation.
Hello everyone, and welcome to the Compact Market Wrap Update for August 17, 2026. I'm Moe and Javaid, President of Compact Asset Management, joined by Javaid Ansari, Executive Vice President. Thank you for joining us today. Looking at the markets, let me remind all of you, click on the like, subscribe, and the bell. That is important. So whenever we post an update, you'll be notified. If you want to look at all the previous episodes, you can also go to compact.com, click on Insights. If you need help with your portfolio, you can always give me a call at 800-388-9700 or just send us an email at invest@compact.com. Let's start with another reminder, Wealth and Wisdom and Wealth Solutions. We've got a YouTube update besides the book. It's a tremendous book. I know a lot of you have read it. A lot of you have sent me notes on it. I just got another note today, somebody thanking me for the book. Well, I didn't do it. Feroz wrote the book. Now what we've done is summarized all of the book. There's 6 episodes at youtube.com at Wisdom and Wealth Solutions. You can go there. There's 4 short videos describing the concepts of the book, and obviously the book launch event that was at University of California, Irvine, was with an interview with Feroz. All of the content is there. So go visit Wisdom and Wealth Solutions and get all of this information. It's all free. There's no cost or obligation, and I think it's a great book. You'll enjoy it. Javaid, let's start with the numbers. Market's slightly higher, but sort of struggling. What do you think?
Yeah, I mean, we made new highs over the last couple of weeks. S&P up 0.39%, Dow down 0.5% last week. Russell's been doing great all year, up 1.15%. Year to date, up almost 24%, leading the way, which is great. Growth, up 0.5%, value up 0.4%. Looking at year-to-date numbers, growth is only up 6%. Kind of your Magnificent Seven is only up, let's say, 3.5–4% this year, where you have value is up 24%. So if you look at value, equal weight indices, what's been one of the themes this year is where we really have seen a broadening out of the market, and that's a very healthy stock market when you start to see that. EFA only up 0.6% last week. Emerging markets up 2.67%. Just over the last couple of weeks, we've really seen semiconductor stocks really take off. In emerging markets, as we talked about, has gotten a lot more semiconductor focus. Taiwan Semiconductor, Samsung, SK Hynix, they're all playing a much bigger portion of the emerging market index. And so emerging markets, I don't really kind of put it, yes, it is international diversification, but EFA is more your international diversification. Emerging markets is, in my opinion, a little bit more of a pseudo play still on AI. And I think we're going to talk a little bit about the chart of the week, is that you really have to understand what you're buying when you're buying these indices now. We've seen technology become such a big component, and we'll dive deeper into it, but you really need to now kind of understand, what do you own, what indices do you own, how much of those indices constructed in certain technology or other sectors, so you're building that really well-balanced, diversified portfolio that's really going to help you. You're making money, which is great. That's what we're seeing right here. But we're really going to see the benefit of the diversified portfolios when we start to see that volatility again, which with the valuations where they are today, it is just a matter of when the volatility comes back into the market.
Energy is back up now. That's the thing that we've got to start thinking about, and the war is not going away. That's really what it has become now.
Yep.
And with that, we're continuing to see this slow grinding sort of war, which doesn't seem to end. And the Iranians have decided they want everything and anything, and they're not going to stop until they get everything that they want. So it is a very tough situation right now, and with energy prices back up, most of the Gulf countries are stuck at this point. They can't seem to defend themselves against the drones and the missiles and all of that. And Iran has said it'll destroy all of their energy infrastructure, all their refineries, all their pipelines. Mm-hmm. They've already shut down the Straits of Hormuz and the Mandad, the other on the Yemeni coast. So it has become a big problem, and how long this can last It's a question, now it has become more of an economic war. It's economics where we blockaded the Iranians. The question is, who can last longer? Will the Iranians last with this blockade where the economy is crumbling? Or will the economies of the world, basically it's Asia, Europe, everybody that depends on energy, will they run into higher inflation and slower economies? So it has become an economic war and a wait and see who crumbles first, who gives in first. That's what it has become. And that's why we'll have to wait and see. But Iran has had, we've had sanctions in Iran for 47 years. So will they give in? I don't know. They have sort of set up their economy. They don't care about their people. That's one thing that we do know. All they want to do is hold on to their power, and the IRGC, the Iranian Revolutionary Guard Corps, that's now running everything. It used to be just the one part of the army. Now they've become the total army. They've taken over the entire Iranian army. So we'll have to wait and see how long this lasts. But the longer it goes, the more problems it will become economically for the West.
Well, and I think we know. The situation's not getting any better. We've talked about monitoring oil prices. Oil prices today, DBO, which is an ETF we monitor, is back above 21. So now we're kind of in that red zone, which now you have to really start to look at not only energy, and so how does energy play in your portfolio? Well, it was up 7.3% last week. It was up 40%. Energy is the best performing sector this week. Not because these companies are doing great, it's just because now you're starting to potentially have a long-term supply constraints with the Strait of Hormuz and maybe even the Red Sea and the Houthis at some point off the peninsula of Saudi Arabia. And so as Mo just talked about, eventually that can, oil prices go up, consumer prices go up, things start to slow down. We've talked about it almost ad nauseum. It seems like this is now dragging on. Now we're in late August, which started in March. One of the key things to really continue to watch is basically commodity and oil prices, but particularly gasoline prices, because the oil basically feeds into the gas. Right now we're still at $4. Fine.
We can live with it.
We can live with it. But if DBO stays above 21 over the next couple of weeks, you're going to see gasoline prices go to $4.50 and then $5. It's really $4.50's break even of where basically you go back to all the tax benefits everyone had with the OBB Act. But it's really $5 is where now we're starting to tip into that recessionary point. So we're going to continue to watch that. Market will sniff that out way before gasoline prices hit $5. And so that's just something that will continue to play out. I think there's also an element of timing in the sense of what could happen here. I don't think Iran's going anywhere, as you said. And so I think the question is actually for the West, particularly the administration, of whether they want to escalate or not. And that's the big question. But because we're headed towards a midterm election at the beginning of November, I don't think an escalation, and also you have record temperatures also in the Middle East. So we're talking about escalation, as we've talked about, is boots on the ground to really try to force a regime change from the Islamic Republic as it is today. I just don't see that necessarily happening either, number one, before the election because of the weather, and because I don't think you want to be starting an escalation headed into midterms. I don't think that's going to do well for the Republicans.
But what after the midterm? If the Democrats take over, which is...
Well, that's why I think the midterms have a huge implication on what happens in the Middle East. If the Democrats take over, then it's just going to continue to meander for a long period of time. And then, if you're not able to kind of really get to the heart of the problem and change the problem and open the Strait, right? If you're not able to open the Strait,
you can't escalate that, basically.
But then it's kind of a slow death to a certain degree, because then if oil prices continue to move higher, eventually that's going to force a global recession. The other thing is then the escalation, but I think the escalation is only possible if the Republicans are in complete control.
Right.
And so then the escalation also has a whole level of externalities and negativity to it. It's not all great. They're just going to roll in there, overthrow the regime. There's going to be a tremendous amount of loss. And so I think the situation is it's no good all the way around.
There's no easy solution.
Well, there is an easy solution. You just and the other solution, which is the other outcome, which I said is stalemate, escalation, or de-escalation.
How do you de-escalate? There's
You-
no
you-
there's no
no, no.
de-
There's
de-escalation.
there's one easy way that the U.S. can de-escalate. They send $300 to $400 billion to the Islamic Republic, and the
Oh,
Islamic Republic
complete, basically surrender
yeah,
to Iran.
which I'm not ruling out, because the other two scenarios are potentially too much. The status quo situation, I don't necessarily, no one really knows. It's just kind of slow. The escalation, we clearly know there's, you're taking on additional risk, and
Tremendous
whatever
risk.
the outcome is, the Republicans particularly will have to own that.
Right.
I don't know if they want to go into that particular type of level of risk, both politically and we're also talking,
Economically.
human lives here. No, forget economics. We're talking, people dying in a war. And so that's why I still feel like the capitulation type of situation is still on the table, and I think the market is still looking into that. Now it's hard politically. I think it's a little easier politically if the Democrats win, and then you can kind of
You can just say, hey, they don't want us to go to war. We can't escalate.
We cancel
so
it. We gotta
make a deal.
It's not so much about making the deal, who made the deal, whatever. It's just the market only cares, is the deal made or not?
Right.
Is the Strait open or not? The political fallout and all of that, market doesn't really care about that. The market just cares, hey, is the Strait open? Is oil flowing or not? And so I think all of those things are definitely in play, but we're not going to get any resolution on any of this potentially until after the midterms. So
And
then,
that's why I think the market is not going anywhere.
correct. I
It's
think
just biding time, waiting to see what happens. It's just going up and down, back. We hit new all-time highs last week. So that's great. But how long can this last? And I just think we're losing a lot of momentum in the market right now.
And we'll talk about it,
We'll
especially
take it.
on the technicals. But I think
Exactly.
it's just, you always want to just kind of lay out the framework of what's happening. We don't know what's going to happen.
No one does.
But we do kind of follow things. The market gives us some indications, and particularly, oil prices are our best indicator in terms of, okay, what is the risk of this flowing into a recession? What is the probability of a deal, of a no deal? Right now, oil prices are saying, things are not good and they're getting worse.
Right.
And so, it's definitely saying that you're not getting that inclination that a capitulation is on the horizon, which I don't think is, once again, is going to happen until after the midterm. So that just, I think, paves, we got to watch things, I think, here as we get
Very
into
careful.
September and October, which traditionally, seasonally, is a very weak time for the stock market. I think it's something we need to be watching really closely here. So you got to get ready.
Interest rates didn't go anywhere. We did get CPI and PPI last week.
Yeah, so inflation was really confusing. I mean, on the core side, CPI side of the equation, it cooled to 2.5%. But on the producer side, PPI, it's up at 4.4. So we're going to get some more, the FOMC meeting minutes come out this Wednesday. So that's going to give us some more detail around kind of what the Fed is viewing. I think they're between a rock and a hard place. They want to basically, they want to ease rates, but with the situation in Iran and oil prices going up and AI and all this investment associated with AI, promoting growth and all this investment, they can't cut interest rates. So I think, market's okay with where interest rates are at. I don't think interest rates are going up, short-term interest rates. I don't think they're going down. The long-term interest rates are continuing to go up, which we're seeing, but I'm okay with that as long as they're going up for the right reason. And the high yield bond market, because it's remained very, very, you see it right here, is up 0.14%. AGG was down 0.14%. Interest rates potentially are going up because of the promise of AI, because of the productivity gains and all of these other things. And so that's actually a good thing when you're having the yield curve steepen, where you have long-term interest rates going up much faster than the short-term interest rates. So I think all in all, the bond market is stock market, maybe, we might see some hiccups. We can easily say a 10% correction for no reason. That's just price of admission of investing in the stock market at these valuations. But the bond market's saying, keep cool. Everything's still looking pretty good. If we get that decline in the, in September and October in the equity market, and the bond market starts to flip a little bit, then you'll hear our tune change here on Market Wrap. But as of right now, I still think everything's looking pretty good.
This is an interesting chart that I saw this week, the weight of technology sector by U.S. asset class. Everybody says, oh, I'm just going to buy the S&P. I'll have a diversified portfolio. No more, is it?
No, absolutely. So the chart of the week is just showing across different asset classes, particularly if you look at venture capital and S&P, technology represents around 50% of these indices. Now, technology is great. That's where we're seeing the earnings. That's where we're seeing all the growth. But it's also important to have diversification. And so this is what I was talking about earlier part of the pod. You just have to be very careful around when you're buying the S&P now. Maybe you're coupling that with some small cap, maybe some value, maybe some international, maybe some high yield bonds, or even, I think bonds, regular bonds, investment grade corporate bonds, even treasuries are pretty attractive, at these levels. But you need to kind of look through just the indices, and so far that diversification is allowing you to really still get returns, in line with the S&P this year, but you're doing it with much different levers or contributors to your portfolio. And when everything's still floating up, you don't quite see the value of the diversification. But like I said, the key point is how your portfolio also holds up on the downside, particularly if things are going to get recessionary level volatility, not just normal pullbacks, but recessionary volatility. That's where the diversification really is going to pay off. So you really got to just pay attention. When I'm even recommending private equity for some of our clients, I'm very cognizant of making sure that when we're investing in different managers, we're not having overlap within those particular investments. We have a nice broad swath of international and different sectors, and take some time. And so you need to kind of go through and just make sure that you're understanding, you're looking through, doing that X-ray.
More and more companies are not going public. They're staying private for longer and longer.
Correct.
So by the time they go public, the valuation has already gone up so much. There's no juice left, as I would say.
Yep.
In the IPO, it used to be the old IPO where the market came out, the company came out and grew when the IPO came out. But now we're starting to see that all the money has been already made before they go public.
Correct.
That's why you have to participate in private equity and venture capital, but how do you do it? That's the hard part. How do you buy SpaceX 3 years ago? That's the kind of thing that you need to think about and look at, and that's where your advisor gives you access to these, does the homework, make sure you're not buying the same companies in private equity, make sure you have a diversified portfolio and look through all of this, and make sure you have a diversified portfolio. Just having the S&P, you're investing in technology now, basically what it is becoming. Buying emerging market, you're buying 3 companies. That's basically what you're buying. You're not buying the small countries, you're buying 3 stocks basically. There are the highest weight in emerging markets. So you have to look through these indices now or have somebody do that for you. If you want us to do it, give us a call. PPI, CPI, we talked about it. You just talked about it. Not a little bit confusing. I think we'll get some clarification over the next month or so. These numbers were sort of mixed bag right now. This week, we don't get a lot of data, do we?
No, not a lot of data. I mean, earnings have been great. I was looking at profit margins on the S&P 500, 16.5. I mean, I remember when Goldman was talking about profit margins at 10% were too high.
8% they said were great.
Yeah, now we're at 16%. But then what I also like is even if you look at international, countries outside of the U.S., profit margins have gone up from 9.6 to 12.3. So profit margins, that's why you're seeing international, once again, markets follow earnings, and profit margins a way to assess that. So yeah, everything's still looking pretty good. I think everything is still very much in a growth type of mindset. Values outperforming, but I'm just saying, GDP growth and interest rates are going higher. I know that can make the stock market look a little bit more expensive, but as long as the valuations are there and the earnings are still continuing to come through, which they have this season, we're still looking pretty good.
Let's look at the technicals,
Yeah.
and this is an interesting chart. We saw a new all-time high here in the market, and we right there, you can see the RSI made a new high. Here we made a new high in the market. These are prices up here. This is the relative strength index, not a new high. Here we saw another.
We saw a little pullback there in June.
Yeah, this is the pullback. But you can see new high for the market, not a new high for the RSI. Here we're seeing new highs again. RSI should be higher, but it is not. Diversification, divergence. And that's what it's showing, that the prices are going to new highs, but the technicals are not supporting the prices. That's what, and that's when you see a fifth wave, which we're seeing right here on dailies. This is the target, Fibonacci target from here to here, and we are right there now. And we're seeing divergences, sort of a yellow flag.
Yeah.
It's a yellow light that you have to be cautious. You can't be swinging for the fences. You can't be chasing the market at this level. That's why we're emphasizing so much that you need to have a properly diversified portfolio.
And I'd just like to kind of make sure all of our Market Wrap listeners, and as well as viewers on YouTube, when you're looking at a daily chart, you're very much kind of more, we're looking at like, the next play, right? It's very much a trading type of kind of outlook. And that's why we also look at weekly and monthly charts to kind of understand more of it from an investing in long-term perspective. And so just because we're seeing maybe a pullback on the dailies, it might not change the long-term trend on the weeklies or the monthlies. Right? But it's just saying, basically since June, yes, everything's great. We're at all-time highs, but maybe we're a little tired here and maybe setting up for a pullback eventually.
Here we are looking at the weekly chart. Each one of these green and red lines is 1 week of trading. This goes back to 2023, as you can see all the way back here. Here we are again at a fifth wave high, but fifth wave highs in weeklies can last for months, not weeks. It can continue, but we are new highs. Target is right above, somewhere around 8,000 or 8,100 is what we're looking at as a Fibonacci target. So we could go there. We're 7,750 today, bouncing around there. Support is at around 7,400 and then 7,000 on the downside of the market. So you get a pullback, 10% pullback takes us back to somewhere around 7,000 or so. NASDAQ daily, same thing. We're looking at markets coming, stuck in a range here.
It'd be interesting if we could get above that
27,200, the all-time high.
Yeah.
That we made in May. We haven't made a new high in this market since May. S&P has gone to new highs, Dow has gone to new highs, but the NASDAQ has not. So we're sort of in our trading range since May, going back and forth. Weekly, same thing, pushing, but not quite there. This is the small caps. Small caps look a lot better.
Yeah, no, small cap. And this is why I think it goes back to kind of trying to read the tea leaves, but this is why I think now is actually still a good time to buy bonds. Interest rates have risen, but small cap is also going up. And really, if people are really worried about interest rates going to the moon, small cap would not be rallying because they're very interest rate sensitive. But I think small cap is rallying in the face of higher interest rates because there is potentially some growth, right, continuing to kind of filter down now because of AI across all of these different companies. And so the fact that small cap is outperforming to the upside tells me that, maybe you can buy a little bit of small cap, but I think it's just telling us the broadening out is there, diversification's working. But I think it's also giving another signal where if you do have cash, now is the best time, I really do feel, to really get that invested, maybe just a little bit up the ladder, get a bond ladder, get some corporate bonds, get some treasuries, ladder them out over 5 or 6 years. If you'd like me to take a look at it and my team, I have a set fixed income portfolio that I've been talking to clients about. Just give us an email at invest@compact.com or give us a call, 800-388-9700. But I think now is a really good time, and we'll talk about the treasury chart here in a second. But international looking great.
Same thing as small caps, looking good on the upside. Really nice trend to the upside. This is looking a little dicey right here. This is the daily chart for oil.
Yeah, I mean, it's in a range. Clearly everyone was getting all excited in late June when it broke below 19. Did it for a little bit, but now back up to 2150. So yeah, we're in that danger zone again. This is really when oil prices can start feeding into gasoline prices. And once gasoline prices start going up, they don't go down as quickly as oil prices. So even if oil prices come back down. So this is definitely a piece that I think is ultimately going to keep the Fed, very much, forget easing, but potentially if this thing continues to go higher, they're going to have to look, to potentially raise rates come September.
And your note, again, 10 years going back up to the highs, pushing right here today at 4.72 pushing towards 4.75.
Yeah, and I think just, with the rates where they're at, that's just another reason you can easily see a 5-10% pullback in the market, just to kind of reset things. Just so the market says, okay, we just need to kind of take a breather, work off some of the bullishness and just kind of shake things out a little bit and then go forward from there. But, that's why we also look at the HYG chart, right?
Yeah,
And the HYG chart's still looking. You can fast forward. Go
gold is not here. Here we go.
Yeah, HYG, you still look at this relative strength chart. I mean, it's at all-time highs. So, AGG has taken it, has been on a downtrend since July, since we've seen that rise. But HYG has continued to actually go to the upside. So that just tells us, growth is still there, and don't need to worry about it for the time being. But like I said, I think is when the S&P is not ripping 25% in 1 year, and that's when you see it's
That's
not,
where
it's not,
diversification pays off.
well, you've always said it's not what you make, it's what you keep that counts. A lot of people make a lot of money when they're trading all these other things, but they give it back and then some. When things turn. So now is the time to just slowly but surely, nothing drastic, but make sure you're infusing some diversification into your portfolio.
Make sure you click on the like, subscribe, and the bell. That's really the key. So the bell is when we post an update, you get notified. So make sure you click when you're watching the YouTube channel. If you need help with your portfolio, give us a call, 800-388-9700, or just send us an email at invest@compact.com. Thank you for spending this time with me. We will be back with you next week. Looking at the markets, these were our thoughts. These are our observations. We will be back with you next week. Until then,
Good trading.
This presentation contains the current views and opinions of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.